3, 2, 1. Hey guys, welcome back. I know today has not been a nice day to all of us. Stock market went up and then came back down. Okay, here are some of the explanations behind the moves. When we look at the stock market crash, it is almost similar or parallel to 1987 stock market crash, which is named Black Monday. What happened is that in 1987, Black Monday, on Monday, October 1987, worldwide losses were estimated 1.71 trillion US dollar. The severity sparked fears of extent economic instability. Possible explanation for the initial fall in stock prices include a fear that stocks were significantly overvalued. Just the fear may not be really overvalued, but include a fear that stocks were significantly overvalued. Now, when we look at our stocks here today, look at Palantir. 2 years ago, OMG, $5, $6 per share. And now, last month, it was $200.47 per share. Okay, let's look at another one. It's a little slow. App Loving. 2023, 2 years ago, oh my God, $7, $8 a share. And I sold everything. I bought at $41 per share. I sold everything at $603 per share right there. And I paid off my car loan. I paid it off. And after I sold all the shares, it went to 700. And now it back down below the price I sold everything. I sold at 603. Now it's 520. See? It is such a crazy ride from under 10, well, 7 or 8, see, $7.26, to 700 plus. What was the highest? 745. 100x in 2 years. 100x in 2 years for App Loving. Wow, OMG. I bought it at 41. I sold everything at 603. No regret. Pay off my car loan. And yeah, and I thought the company share was only worth up to $420 per share, and it went up to 745. And I sold it at 603. And Palantir, when it was $75 per share last year, at the end of last year, I already said this company is a little bit overvalued, and now it's very overvalued. But then it touched $210 per share earlier last month, before backing down now to around 155 and still overvalued. Yeah, it has strong growth, but if you buy it now, you may not see much stock price appreciation for the next few years. Rigetti, computing. Yeah, I know it's quantum. I had the stock since 2023 when it bottomed at 73 cents per share. And I sold everything at $5 per share. Why? Because I knew in end of 2024 that this company will not see a dime in profit for a very long time. And last year, I want to sell everything to buy more SoFi and Palantir, because last year, both Palantir and SoFi Technologies, both of these companies were making huge profit and increasingly becoming more profitable over time. Meanwhile, Rigetti Computing is still not profitable, and it may not see a dime in profit for the next 5 to 10 years. Yeah, it is the next big thing. But when was the last time we heard these words, the next big thing? The EV craze, electric cars? And anybody remember the battery called QuantumScape? It IPO maybe $10-15 per share, went as high as $130-140 per share, and people on the internet say, "Oh, I'm not selling. This is the future." And then it crashed down to $5, below $5 per share last year. Quantum Scape and all the different EV company, even Cathie Wood bought into Lordstown Motor. And where's the company now? Disappeared. So anyway, now let's go back to how S&P 500 look like for the last 5 years. From about 3,500 to now 6,005, not even 1x for the last 5 years. Not including all these. But then it says here for the October 1987 stock crash, what was the return? Oh, the return is 776 as Dow Jones Index, 776 in 1982. It rose to 2,722 in August 1987. Almost 4 times, 3.6, 3.7 times. Yeah, much higher. And what were the reasons for the crash? Is mostly stock were overvalued, or at least the fear of the stocks being overvalued. And then we have persistent US trade and budget deficits, similar to our current state of affairs, and rising interest rates. Yeah, the Federal Reserve Bank seemed to be reluctant in lowering to have rate cuts. Yeah, seem to be reluctant, and a lot of analysts are not expecting a rate cut in this upcoming December meeting. So it kind of give the market another reasons to come down. And the decline of dollar. See, we also have the decline of dollar now. Followed by lack of faith in government attempt to stop that decline. Wow, interesting. There are quite a few parallels here. And then let's look at, okay, here, there are some explanation. Black Monday in 1987 was caused by combinations of automated program trading. Nowadays, we also have AI programmed trading. Strategies like portfolio insurance and investor panic, all amplified by an overheat market that was overdue for a correction. See, here we also have many stocks that we just look at, they have been up 100x in the case of AppLovin. It's due for a correction. A lot of companies are not even profitable yet, and they are just up and up as if there is no tomorrow. That is too crazy, okay? And many people are on margins, and even the professional trader and professional investors are on margin. Yeah, so this was a major accelerator, program trading, okay? And then portfolio insurance and market psychology and panic, and then overheat market, experienced a long, strong bull run since 1982. So, you cannot just keep going up on a straight line. Somehow you have to catch a break. Other contributing factors, broader economic issues such as rising interest rates, inflation concerns, and geopolitical tensions. We also have that now too, between USA and China. Okay, never mind. The simultaneous expiration of stock options and future contracts before that Monday, that Black Monday. So tomorrow, November 21st, is also option expiration day. Wow. And then the coming Monday, 20th, 23rd, 22nd, 23rd, 24th, Monday, November 24th, 2025 will that be another Black Monday? Interesting. Yeah. See, stocks were bullish before the 1987 crash due to a strong bull market. Now we are also in a bull market and is also very, very strong, very bullish. And we have also some rate cuts, although not as many as we would like, but still we have lower interest rates compared to last year. We have also quite a good deal of corporate takeovers, because they are trying to expand to the vertical markets and horizontal markets. We have companies buying out other companies. Similar situations and a wave of new investor money. Yeah, we have also Gen Z investor money coming into the market. Wow, so many parallels, particularly from foreign investor. Back then, factors like aggressive mergers and acquisitions, leveraged buyouts, and the excitement surrounding technology stocks, AI stocks now. Back then was technology stocks, also contribute to the market run-up. Though these factors also mask an overvalued market with unsustainable price to earning ratios. Price to earnings ratios. What is the PE ratio of Palantir? 389. For each dollar of net profit, you are willing to pay 389x, meaning 389 times, to buy that $1 of profit. It should sound some alarm, yes. So guys, next thing is let's take a look at how Cisco, as the number one front runner, the biggest market cap company at that time before it collapsed. It is just like Nvidia now, going up, and up, and running. And it because of exceptional growth, revenue growth, see, from 1992, 85% year-over-year growth, revenue. We are talking about revenue. 1993 was an exception. I forgot what that was. It was 91%, almost 91%, yeah. And then 1994, 100%, crazy. 1995, 67%. 1996, 83%, over 95. 1997, 57%. 1998, 31%. Kind of where SoFi. Lower than SoFi actually. SoFi is 37 now, right? 1999, 43%. 2000, 55%. So you have all these exceptional growth. When a company year-over-year revenue growth is 20%, such as Amazon, is considered very good already when it is a big company. And Cisco at that time, do you know how big it was? It was the biggest company by market cap. Its market cap was, I remember, was 540 billion. It surely passed the trillion market cap. It was about 540 billion. But then look at the stock price. Just when the quarterly reports show some sign of revenue growth slowing down slightly, look at this. Also, does it look like Tesla? Tesla also goes up like this. Nvidia goes up like this. Do we have Nvidia stock price chart here? I think I probably don't have. Let's see. Is it here? Okay, let me. Nvidia. See that? Right? So now it is the biggest company by market cap. Nvidia. And then when we look at Cisco, it was the biggest company by market cap at that time, 2000, year 2000. 25 years later, it is Nvidia. Same pattern. So many people argue someday, maybe not now, but soon, Nvidia will be showing some sign of slowing down too. You never know. You just never know. Nobody can really expect, because AI is so promising. It just kind of tickle our imagination to think about what it could be like, to imagine how it may improve our human lives, stuff like that, to do the impossible or the impossible thing, cure cancer with AI, find the next big drug or drugs, So yeah, a lot of these. Um, wow. So much similarity and parallels. And okay, let's move on to the next topic. Sina, yes, Cisco was experiencing exceptional growth in revenue and market capitalization immediately before the stock market tanked in March 2000. See, even the market tanked in March 2000. Cisco was still experiencing exceptional growth, both in revenue and also in market capitalization. So why can we have a market crash if now the biggest company by market cap, Nvidia, will be still having strong growth prospects? But market stock is a vehicle that foresees future events. Maybe 1 year down the road, sometimes it's just few months down the road, but sometimes it foresees event that is 1 or 2 years down the road. So, and Cisco revenue surged 850% between 1995 and 2000. Wow, it's just like Nvidia now. For the fiscal year ending July 2000, net sales were blah 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 blah. Yeah, that was the past. And then the stock was trading at extremely high valuation, over 100 times its forward earnings, and 220 times its net income per share. What was Palantir again? 389? Man, you do the math and see the aftermath. Or do the math and avoid the aftermath, I should say. All right, let's move on to the next topic. Oh, we have Nvidia Q3 earning report. Let's see if I can click this. I go here. I want to bring to your attention to the 10Q. What is 10Q is the filing to SEC, Security Exchange. A company can modify the way how they want to communicate their financial results to the investors during the earning call, such as how Jensen Han was CEO of Nvidia, was presenting himself and presenting the financials very nicely in very energetic way, always sound bullish. But then 10K is how the company will show everything that is not word to word disclosure during the earning call. We can see in black and white. Okay, so now I want to bring to your attention this 10K. For we have 4 customers account for 22%, 70%, 14%, and 12% of the account receivables. The account receivables are increasing. I remember I marked it somewhere. Is it here? Cash flow. I want to let you guys see the accounts receivable increases. So their clients are not paying them for some reasons. Okay, right here. It's increasing. Account receivable is increasing. The clients are not paying them on time. Inventory increase. You can attribute it to the company is foreseeing more demand for their products, their chips, the AI chips, so they have more inventory already made, pre-made, and just staying in their warehouses and waiting to be sold or delivered. However, I want to let you guys see this. The raw material strangely only increased slightly, maybe 10% compared to January of 2025. Work in progress is a huge increase because the company expecting to sell more AI chip in the near future, so they have more AI chip being in different stage of manufacturing, so that those would be in the work in process category. Finished goods, interestingly, they have a lot. But I remember Jensen was saying for each chip that NVIDIA has made, it's already delivered and sold. So how come the finished good increases here? This figure is crazy. Increase so much more than 100%. Because if you are sold out, it should be even much lower than previous number. How come there's so much inventory? But CEO said during the earnings call it was sold out, all the chips. And then prepaid supply and capacity agreements to their suppliers decreases. Doesn't the company expect to sell the demand increase for the AI chips, and then to be able to sell more AI chips, then they have to prepay more to their suppliers in order to get all the materials to make the chips? How come the prepay go lower? Doesn't something that don't really match with the presentation yesterday during the Q3 earning report or conference? Interesting. This is needs some more time to take a closer look. So okay, here is a when is the time increased inventories are a good sign. Economic confidence. We talk about increasing increased inventory for NVIDIA chips. A business may increase inventories to show confidence in a growing economy and anticipate higher sales. Anticipate demand growth. Supply chain risk mitigation, which is true due to they may not be able to get much supplies from China. High inventory turnover. Okay, then when are increased inventories bad give when do they give us a bad sign? Warning demand, decreasing demand, cash flow issues. Inventory represent money tied up. Yeah. Storage costs. Yeah, because you have to store them. Risk of obsolescence. Yeah, become less valuable. Reduced flexibility, tied up all the inventory and cost and resources. Lower raw material. Okay, now let's address that issue. Lower raw materials and high finished goods inventories is generally considered a bad sign for a company, which it does show over there. If you remember, raw material is quite low. This increase maybe 10%, but then finished goods increase more than 100%. While raw materials increase only 20, maybe 10-15%. Here are the reasons why this combination is a negative indicator. High finished good inventory, tied up capital. See, increase the costs. The company incurs higher carrying costs for storage, insurance, labor, and utilities. Risk of the same things. Spoilage, weak demand. But I remember Jensen said the demand was so high that all the chips were sold out. had been sold out. Huh. Weak demand. Yeah, low raw materials inventory, production disruptions, a shortage of raw materials can halt production lines, leading to missed deadlines and the inability to build new products when the existing stock sells. Rushed orders, higher costs, inability to meet future demand. When finished goods eventually sell, low raw materials will prevent the company from quickly replenishing stock. My guess is maybe the company is very good at communicating with the suppliers, so the suppliers just ship the raw material to NVIDIA. In short notice, I'm not sure. Interesting. Yeah, that need to be. I need to dig deeper on those. Here comes an interesting thing. Now, with all these increased demand for AI chips, who causes all these demands for AI chips, right? See, Microsoft and NVIDIA have a partnership to provide 15 billion USD to Anthropic, the AI company, as part of a strategic partnership where Anthropic has committed to purchasing significant cloud computing capacity from Microsoft Azure. I think it was 30 billion. And then some hardware from NVIDIA. So how it is figured is Microsoft and NVIDIA will give 10 billion to Anthropic. Microsoft will give 5 billion only to Anthropic. So NVIDIA give 10, Microsoft give 5 billion to Anthropic. Then Anthropic in return will buy 30 million worth of Microsoft Azure cloud computing. And then some money back to NVIDIA to buy their chips. Oh, by Microsoft. Yeah, Microsoft to buy the chip from NVIDIA. So is the money from Microsoft and NVIDIA go to Anthropic? Anthropic is giving the money back to Microsoft. Microsoft is buying the chip from NVIDIA. It's like money going around the three parties. It's like you, me, and another guy called Bob. You give me $5. Bob, give me $10. I buy cookies from you. You buy the dough from Bob. It's like money going around. So I record. So you record all the sales from me. So you record higher sales, and Bob record higher sales because he's selling the dough to you. And then you record higher sales. Oh my God. I don't know what to say. Is it a good scheme? Or is it a scam? Remain to be seen. I'm not gonna judge now. Yeah. Oh well. This is one of the reasons I have never bought a share of NVIDIA actually. Yeah, I don't buy companies that I don't really quite sure if I understand them enough, you know. Yeah, one thing about investing, buy only what you understand. If you only understand shoes, you know, you like Nike or Allbirds shoes. If you only like buying apparels, you know, if you like let's say Lululemon or you know other apparels, if you only understand supermarkets, you know, you can buy something like, I would say maybe Costco. Yeah. Yes, I mean everybody has their own way of understanding things, right? And not everybody is jack of all trades, so we are more proficient in certain areas. All right. Yeah, and Anthropic has committed to purchasing 30 billion worth of compute capacity from Microsoft's Azure cloud services, which will run on NVIDIA hardware. See? So NVIDIA and Microsoft give Anthropic 15 billion, Anthropic give 30 billion back to Microsoft Azure. Microsoft in return buy chips from Nvidia. The money go around, money go around. Okay, cool. Anthropic will also work with Nvidia to optimize its AI models for Nvidia chips. Wow. All right, interconnected world, I guess. Let's also look at Nvidia China business flattered in the AI chip makers' third quarter. Of course, we are not selling anything to China. And China makes up at least 45% of the world's AI demand. Anything related to AI, you don't even have to ask me which kind of AI or which segment of AI. Anything. China is just a mass consumer of that, right? Of course, they have 20 to 25% of the world's population. What do we expect, right? And if we are not doing business with China, we are shooting ourselves in our foot. Pew! Okay, Nvidia record just 50 million in sales of its X20 chips to China. Yeah. Oh well, what can we ask? What else can we ask? All right. The next thing that we will look at is it looks like the next rate cut is in doubt, to say the least. Federal Reserve Bank Governor Lisa Cook stated in a recent speech that asset valuations, including those in equity stock, corporate bond, housing, and leveraged loan markets, are elevated relative to historical benchmarks. She warned these conditions could lead to outsized asset price declines. Yeah, what goes up must come down, right? That old saying. Of course, this is when only people use a lot of leverage buyouts or leveraging on margins for loans to buy stocks, to buy housing. Yeah, that could lead to instability. When value comes down, there will be margin calls for stocks, and then there will be banks that may foreclose some houses. Instability. Key details from her speech. Financial stability. Cook emphasized that while current valuations are high, she believes overall U.S. financial system is in resilience enough that a market correction would not likely trigger a crisis akin to the Great Recession. No, it should not, because of a lot of the employment data, although it's kind of weakening, but employment overall is still strong. And AI is really helping a lot of companies to achieve more with less resources, while improving the efficiency. So, yeah. Role of the Fed. In her November 20th, 2025 speech on financial stability, Cook clarified that the Fed's role is not to offer investment advice, but to observe when the expected compensation for risk is low relative to history. Yeah, that's her duty. Other vulnerabilities, in addition to elevated asset valuations, Cook highlight two other potential vulnerabilities: the growth and complexity of private credit markets and the activities of hedge funds in the U.S. Treasury market. Yeah, those are the hedge funds thing. Market reaction following her remarks. U.S. stock indices initially trimmed their gains as investors react to the cautious tone on market risk. Her comments are part of a broader conversation among financial leaders with CEOs from major Wall Street firms like Morgan Stanley and Goldman Sachs, who flagging high market valuations and the potential for a significant market pullback. May not be a crash, but still it would be significant. 20% we are talking about. How come it's not moving? Can I go to the next slide? Thank you. All right, let's look at the S&P. S&P 500 historic ratio. Used to be 15, 7, 29, 70, 2029. Oh, of course, financial crisis. See, the PE are high, so they need to come down. And then a period of lower PE ratio, 2019, it was a great time to buy stock. And then 2021, it's, as you remember, all the electric car craze, and then 2025 is this year. So we have the AI craze. Excuse me. So 30 actually is not that high. Why I'm saying that is because we have AI, we have technologies to help improve the margins, profit margins of companies. In the 70s and 80s, most companies, their profit margins or net profit margins used to be in the teens, below 20%. But nowadays, due to automation, software, um, AI, a lot of companies have profit margin up to 80, 90%. In the case of Palantir, it was 70 something percent, if you remember. And SoFi Technology was, I don't remember. So you have companies that are seeing higher and higher profit margins, so the PE should expand a little bit. But she's using this as a historic valuation monitoring device. So yeah, this is just a graph. Instead of the number, this is a graph to show you the PE ratio over the years for S&P 500 companies. I don't even pay much attention to this. When you have better technology that give you more efficiency, higher profit margin, of course the price per earning ratio should increase, should expand accordingly. But then if it is 200, 300, 400, as in the case of Palantir, of course that is too much, too rich. But 50 PE, even 50 for some company, if they are growing left and right very nicely. But then eventually the growth will, of course, slow down. As in the case of Cisco, and the market didn't like it, and the company stock came crashing down. And even now, it is still not up to the previous height in 2000. Okay, so here we are looking at Palantir. We look already. It's very highly valued, very expensive. If I would want to buy start to invest in this company, I would wait until it comes down to 100 or even below. You want to have a good margin of safety, just in case things don't pan out as the way you expected. You want some good margin of safety. You don't want to buy it when everybody is trying to buy it. Yeah, this is not the right time to buy. AppLovin, I bought at $41 per share at the end of 2024, and then sold everything 603 and pay off my car loan. That was a great move. Yeah, that was a great move. Too bad I didn't buy at the bottom, right? But who knows when the bottom comes in? We only know in hindsight. Vigetti or Vigetti. Yes, I also have it since 73 cents per share, somewhere around 2022. Yeah, I think so. But the low was 36 cents, even lower than my purchase price. It's crazy. 36 cents, and then here is what? Here is 58. Wow. 130, 140x for a not profitable company. And you don't know when it will start to make a dime in profit in a sustainable way, quarter after quarter. I'm not talking about, suddenly this quarter is positive and next quarter back to negative. No, I'm not talking about that. I'm talking about sustainable, consistent profitability. Yeah, this has gone up too much. My God, see, look at this. Look at the last 6 months. Let's see. See, it has come down a lot. A lot of investors feel like, I'm not gonna keep it. I have to sell. I have to sell before other people become rational, right? You want to be one step ahead of other people. Okay, by the way, tomorrow, as we have just talked about at the beginning of this special, tomorrow, November 21st, 2025, is a standard monthly option expiration date. If you remember, we talked about the Black Friday stock crash, Black Monday, October 1987. that Monday was 2 days after the Friday, which was also the day of option expiration. So it is kind of similar in our situation now, and our stocks kind of have a mini crash, if you will, for the second half of the day today. So we shall see. Now, should we panic sell? Okay, if you are using margins, please do yourself a good favor. Trim out everything that is on margin. Okay, trim out all the shares that you have bought with margins. Just keep the one that you purchased with cash or with the money in your account. We don't know how low the stocks can go. We just don't know. A lot of the time, just when you look around, everybody is cheering, everybody is smiling. Oh, I'm having such a good day in stock market. Oh, my account is up another $1,000. Oh, my 401k is up 50,000, 50 grand just last 2 weeks. If you look around, everybody is smiling. Everybody is kind of looking like genius. Oh, I'm such a genius this year. Oh, I have earned so much from stock trading or stock investing. Everybody looks genius. This could be the signal for you. Hey, let me take a look at this big picture. Should I be worrying about something? So for stock market, remember it is an instrument that always try to expect the upcoming events in the foreseeable future. Meaning foreseeable future means the next few months to a next couple of years. So if it is expecting that we may not have a rate cut in this coming December or even the next quarter for 2026, then the market is going towards the worst case scenario. It is just thinking, oh, we will not get any more rate cut. The last one was the last one. That's it. And it's also pricing in the worst case scenario for NVIDIA. Yeah. And also the worst case scenario for our trade conflict with China. So we may never be able to sell any chip to China again. So the market is trying to price in everything. So until we sort everything out, the market will at least fluctuate quite violently, okay? Even if it doesn't crash all the way down. So just give you guys a heads up. Don't over stress about it. We are here for long term. For SoFi, it is not really in the grand scheme, not really in the only theme of AI. It is more fintech, cryptocurrency, and also overseas remittance. And it has more and more institutional clients now for its loan platform, its AI cloud platform, and also future cryptocurrency trading platforms, etc. So I actually think if I have to choose only one company to invest in this kind of environments, that would be SoFi Technologies. It is not as crazily expensive if you compare to the price per earning ratio of AppLovin, Palantir, Robinhood. SoFi is more reasonable, more approachable. So, and then it is still not in S&P 500 yet, versus all the other which I have just mentioned, they are all in S&P 500 index already. So if SoFi will see inclusion to S&P 500 in the next 12 months to 24 months, I believe it will give a strong push to the share price to the north, meaning upward. And because a lot of institutional financial institutions, they will have to buy shares of SoFi if they have index funds that mimic S&P 500. Excuse me, I'm losing my voice. Guys, it is such a day. Get some rest and we'll be fine.